Hi, Scott. Good to be here.
What is your outlook? How high is the bar now?
The bar is high. I would say, obviously, the tech sector led the first half. I think you hit the nail on the head. There is the expectations are high for the tech sector. A lot of expectations, high hurdles. So this earnings season is pretty important for tech. If they're able to meet those high expectations, I think the tech rally can continue. If they miss, even if it's a small miss, I think the shares of tech stocks could be potentially be severely punished.
Do you think they're going to live up to the hype?
I think it's going to be name by name. I think for a company like Nvidia selling at the multiples that it has now, it really needs to be a beat and a raise in order for the shares to continue at its current rate. It's hard for us to annualize the current numbers and extrapolate that into the remainder of the year. The hurdle is just too high. I'm
just trying to think of how could they possibly beat and raise after they've already raised to such a enormous degree. How could we have expectations of even more than that?
Yeah, it's tough for us to forecast that as well, not just with Nvidia, but I would argue for a lot of other tech names as well. That's not to say we don't like these names long term. It's just that in the short term, these shares have run so much. We really need earnings and valuation to catch up.
Well, what about the idea of valuation? I mean, do you think that they've gotten way ahead of themselves? When you look at Apple, for example, which you own 31 times or so, is it justified in being there? Is Microsoft justified at a 33 or a 35 or wherever it sits today, 32?
Yeah, like I said, these are higher earnings hurdles. I would say as a company like Apple, $3 trillion in market cap, so roughly 11% of the U.S. GDP. It's roughly 2.6% of world GDP. From that perspective, you can argue that Apple should probably be selling at $3 trillion. Can it make another $1 trillion in terms of market cap? We really need to see earnings growth. And this year, it's actually pretty modest in terms of earnings growth. I think a lot of investors now are looking into 2024, which we expect to see a little bit of a rebound in earnings growth. So we need to see that in both Apple and Microsoft to justify the current valuations.
What do you think of a more broad catch-up trade? Do you think that's in the cards, that these sectors that are finally showing some signs of life are going to have a decent second half, some of the more cyclically sensitive stocks?
I think it has to. For the S&P to do well in the second half of the year, I think you have to have those other sectors perform better. One of our favorites right now is likely the industrial sector, where it's going to see earnings growth like tech, like communications. It's selling at far lower valuations than tech and communications. You really need to see broader participation. Otherwise, it wouldn't really be a healthy market if only tech is leading this year.